Welcome back to Property Unlocked, where we discuss everything property investment, especially for the first-time buyers out there. Now, if you're looking to buy your first investment property, there's a good chance you have a budget of no more than $700,000. Honestly, your budget might even be a lot less. So naturally, we find ourselves asking, okay, what can I actually afford and where can I afford to buy? Do I buy myself a unit in the suburb where I grew up in? Do I buy myself a house further out? These are the questions we ask ourselves. And now here's the problem. Our parents, our friends, even our mortgage brokers, they tell us to buy the unit. They say, buy the apartment, it's affordable, you can buy for well under $700,000, and it's a stepping stone. But I'm here to tell you that this advice is very outdated and it's wrong. Let's look at the data. In Melbourne, Sydney, yes, you can buy your unit in the suburb that you grew up in for under $700,000. But is this asset actually going to grow your wealth? The answer is no. And this is because historically, units have grown by no more than 5% per annum. Honestly, a lot less, between 2 to 3% if you're looking in Melbourne. This is not a stepping stone. This is not going to give you enough equity to refinance in 18 months' time or even 5 years to go and buy a better investment property. So it's not a stepping stone, it's a dead end. So instead, what if you use that $700,000 budget to buy an investment property interstate in a city that is actually growing and that will grow your wealth? That's exactly what I've done personally for my own property investment portfolio. It's what I've done for hundreds of clients, and it's what you should do as well. So today we're going to break down the cities around Australia where you can buy a house for under $700,000, and we're going to discuss which would be the best investment for your property portfolio. So Brisbane, Melbourne, Adelaide, Perth, Darwin, which is the best investment? Let's dive in. First up, let's talk about Brisbane. The infrastructure spending here is on another level thanks to the 2032 Olympics. Now, we're not just talking stadiums, we're talking new roads, hospitals, amenities, train stations, and jobs, lots of jobs. Because when we have infrastructure spending, we need workers. And of course, this creates job opportunities, promoting migration. This means more people moving to Brisbane and more demand. More competition on house prices, and this is what fuels capital growth. So in short, we can't ignore the positive effects that the Olympics will have on Brisbane and southeast Queensland as a whole. So where can you actually buy a house in Brisbane for $700,000 or less? Let's go 26 kilometres south of Brisbane CBD to the suburb of Woodridge. Pretty sure this one was featured on Spanion, so that's a bit of foreshadowing. Now, the typical house price here is $724,000. Houses are selling quickly in just 35 days. Both vacancy rates and stock on market are very tight, both under 0.5%. This tells you that there is a shortage of both rentals and houses for sale. So there's a lot of demand in the area despite its negative stigma, and this demand fuels capital growth. But here is the catch. In Woodridge, 62% of houses are rented, and in some streets, 1 in 5 houses are social housing. This signals a lower socio-economic area, with many households relying on government support. The crime rate, 30 out of 100. Now, here is why that matters. When the economy goes through a downturn or when Brisbane's market cools off, these suburbs that are lower socio-economic, like Woodridge, will be the first to go down in capital growth, and they are the hardest to recover. We can look north of Brisbane. An equivalent would be Deception Bay, where you can buy the house for $700,000. Now, it is further away from the CBD, 40 kilometres north. But in Deception Bay, you'll get lower crime, less social housing, and a stronger owner-occupier base, which means it's a more resilient suburb. Renters still make up 40% of the population, which is still above what we like to see. We prefer 35% or less. However, that's a lot better than Woodridge. The vacancy rate and the stock on market are both under 1%, which is good. The investor metrics are strong. They are positive and it is still a buy. And when we're comparing Deception Bay to Woodridge, it is less risky because of the higher percentage of owner-occupiers. So one thing is clear. Brisbane is a resilient market, the stock is tight and it will continue to grow. However, with your budget of $700,000, you are looking at the lower socio-economic suburbs. And we know now that this is riskier because when there is the economic downturn, they are the first suburbs to fall in price. Now, one thing we have to address is that if you bought in Brisbane in 2020, you could have bought a house for $300,000 in either Woodridge or Deception Bay. Now these prices have more than doubled to $700,000 in just 5 years. But between 2008 and 2018, 10 years, the market did absolutely nothing. So Brisbane, although it's a capital city and although prices have risen, it is not a blue chip market. We don't have historical evidence of long-term, consistent, steady capital growth. So with your budget for $700,000, yes, you can get yourself a 3-bedroom house in Brisbane. Are you buying at the bottom of the market? No, you're not. Prices have doubled in just 5 years. Are you buying at the top? Well, you could make that argument. However, stock is still very tight, and I do believe that Brisbane is going to grow well into the Olympics. But with that being said, is it the best place to buy in 2025? My answer is no. Now, with our $700,000 budget, let's fly to the other side of Australia. We'll find ourselves in Perth. And the good thing about Perth is with $700K, you can buy a lot closer to the city as compared to other capital cities. With $700,000, you can buy yourself a 3-bedroom house in the suburb of Thornlie, which is southeast of Perth CBD. Only 21% of residents in Thornlie are renting, which is very low. This means they have a higher percentage of owner-occupiers, and as we know, this promotes a resilient market. And homes are selling quickly in Thornlie. They're sold in 33 days. Vacancy rates are tight, stock on market is tight, so all of these are good investor metrics. Now, what I like about Thornlie is not only is it dominated by families and home buyers, you can get your $700,000 3-bedroom house. But there are families spending $900,000 for the 4-bedroom, 2-bathroom house with a pool. To me, that's a fantastic signal because it indicates families are spending top dollar to get into this suburb. Now, there's very little social housing in Thornlie, really only 2 pockets where you'd want to avoid, one of them being around the shopping centre. But with that being said, the crime rate is actually quite high, 31 out of 100. That is a risk factor for the area. So overall, for the suburb of Thornlie, you have a strong, steady, family-oriented suburb with only a few bad pockets. But let's talk about timing. Is it the right time to buy in Perth? Well, very similar to Brisbane, Perth bottomed in 2020, and in the past 5 years, it's more than doubled. So are you buying at the bottom of the market? Again, no, you're not. But are we at a top? Well, we know that supply increased quite significantly later last year. Around October, November, December, we saw a spike in listings. However, since then, the inventory has been tightening up again. So I do believe that Perth will have another tailwind of growth this year, and you might see another 10% capital growth in the next 12 months. So yes, Perth is still a buy. However, you're not early in that market. If you enter the market now, you're catching the tail end of a significant boom. You're not early. Are you buying at the top? I wouldn't say so, but there are earlier markets for you to consider for your $700,000 budget. Now, let's touch on Adelaide. It's another market that saw exceptional growth post-lockdown. However, would I be buying there now? My honest answer is no, and here is why. With your $700,000 budget, you're buying a 3-bedroom house in the suburb of Salisbury. This is a working class suburb north of Adelaide CBD. Now, let's look at the numbers. Nearly 44% of the demographic are renting in Salisbury. This is way too high for my liking. Houses are taking 48 days to sell on the market. Again, this is too high. That is slower than both Brisbane and Perth. Your vacancy rates and stock on market are both around 0.5%. This is tight, and that's still good. But here is the key issue. we can see that in Salisbury, inventory is sitting at 2.7 months. Now, that's not bad. We like to see that number at 3 months or less. However, it's trending upwards, meaning every month there's more and more stock on the market. And as we know, when there's more stock, buyers have more options to choose from, vendors start reducing their prices, and you see capital prices come down. This is not what we want for our investment property. Take the suburb of Richmond, for example. It's fallen by 3.6% over the past 3 months. That's the worst performing suburb in Adelaide, and it's a major red flag for the whole city. Clearly, the market is cooling off, and you don't want to be holding an investment property in a market that's falling in price. Moreover, Salisbury has the highest crime rate of any of the suburbs we've discussed. 49 out of 100, that's actually higher than Woodridge or Deception Bay. So in Salisbury, you've got a high percentage of renters, you've got a high crime rate, and that is not a good mix. Again, that is signalling a lower socio-economic market, which is less resilient when the market goes through a downturn. In 2022, 5 years ago, you could buy the house in Salisbury for $300,000, now $700,000. So again, Adelaide is another city that has seen prices more than double since lockdown. So to recap, although Brisbane has doubled in 5 years, we still have the Olympics to look forward to and to fuel growth. In Perth, we did see a cool off later last year, but that's starting to tighten up again and does signal further growth. But Adelaide is not looking good. That market is cooling down, buyers are taking their time, they're pulling out, and I would not want to be buying my investment property in Adelaide in the current market conditions. So we've ticked off Brisbane, Perth, Adelaide. Let's now look at Melbourne. Now, Melbourne is definitely the flavour of the month. You have more investors talking about Melbourne. So with a budget of $700,000, I'd be looking at Craigieburn. Now, there are options much closer to Melbourne CBD. We could mention Meadow Heights, Coolaroo, Dallas. However, these suburbs do have more social housing and higher crime rates. Whereas Craigieburn, you have almost zero social housing, you have a very low crime rate. So let's focus on Craigieburn. You can buy your 3-bedroom home for a little less than $700,000, I'd say between $650,000 to $680,000. The rental yields are around 4.2%, so not as attractive as Perth, but better than Brisbane. Homes are selling in 41 days, which is really not that quick. We have stock at under 1%, which is a very good signal. However, vacancy rates are still slightly high, 1.8%. I'd really rather see this below 1%. But the positive to Craigieburn as our suburb for the day, it gives you options. You can buy an older house on a bigger block of land closer to the train station, something with development potential or maybe the ability to build a granny flat. Or if you want a newer property that's lower in maintenance, you can buy in the newer parts of Craigieburn. However, you're looking at a, yes, newer house, but smaller block of land, as little as 300 square meters. Now, here is where it gets exciting. Craigieburn rose by 2.2% over the past 3 months. Annualised, that's nearly 9% capital growth. From 2020 to 2025, prices grew by no more than 30%. Compare that to Brisbane, Adelaide, Perth, which grew by 100%. So you haven't missed out on this huge growth cycle. Instead, I'd be making the argument that it's just beginning. What is interesting is we can see that prices bottomed in Craigieburn last year, December, at $690,000, and they've been consistently growing ever since, now sitting at just shy of $720,000. As I mentioned before, Craigieburn is providing rental yields of 4.2%, and this has been increasing month on month for the past 15 months, and that's very reflective of Melbourne as a whole. You can enter the market and achieve a 4% yield. You're not getting that in Brisbane or Adelaide anymore. So in Craigieburn, I'd make the argument that you're buying at the beginning of a growth cycle. It's dominated by families and home buyers. There is very little social housing and your crime rate is a third of what we saw in Brisbane and Adelaide. Now, one of the biggest selling points to both Craigieburn but Melbourne as a whole is that this is a blue chip city. I can show you 20 years of steady, consistent capital growth in the city of Melbourne. I can't show you that in Brisbane, Adelaide, or Perth. So if you buy your property now in Melbourne, I do believe you're getting in at the right time, and you can hold it for 40 years. You really don't have to think about the asset. And that is because it is blue chip. So if you're focusing on value for money, risk management, a healthy yield, and long-term returns, then Melbourne might be the best option for you. And if we look at the example of Craigieburn, you're buying in an area that is safe and dominated by home buyers. We cannot say the same for Woodridge or Salisbury. Now, this last city will shock you. We're going to chat about Darwin, specifically the SA3 of Palmerston. With a $700,000 budget, you can buy a 4-bedroom house in the suburb of Durack. This is within Palmerston, and it will provide you with a rental yield over 6%, which is very attractive to investors. It's 2% better than what you're going to get in any other capital city. So let's take a look at the numbers. We'll focus on the suburb of Durack. 45% of the population in Durack is renting. Now, again, this is higher than what we like to see. We like 35% or less. However, Darwin is a transient city. People go there for work and they leave. So a higher percentage of renters is very normal in general for Darwin. The vacancy rates and stock on market are both very low, around 0.5%. So you have a supply shortage. Durack has 0 social housing and very low crime rate, similar to Craigieburn in Melbourne. Now, Palmerston has less than 1 month worth of inventory. This is tighter than what we saw in the peak boom of Perth or Townsville, and it's getting tighter every single month. Durack recorded 8% capital growth over the past 3 months. Annualised, that is 31% capital growth. So we could see 30% capital growth in the suburb of Durack for this year. That is phenomenal growth. That is the type of growth that allows you to refinance your property in 18 months, extract equity, and buy your next investment. Whereas in Melbourne, in Craigieburn, you might get 10%. Yes, that growth in Melbourne is steadier, more consistent, but it's not as extreme. It's not going to propel you to buying your next property in a year's time. So yes, Darwin is definitely shaping up to be the next quote-unquote boom market, and it's just a cherry on top that the houses there were mostly built within the past 10 years, so your maintenance costs are very low, and you can achieve a rental yield of over 6%. So on paper, it's ticking nearly every single box. However, there is one huge risk factor for Darwin that you have to understand. Darwin is not a foundational city like Melbourne. It's not blue chip. You can't buy a house in Darwin and hold on to it for 20 or 40 years. Darwin works in big 10-year cycles. So if you buy in Darwin now, there's a good chance you'll be selling your property in the next 10 years. That is quite quick, and we make our clients aware of this before they enter the market. So if you're investing in 2025 and you have a budget of $700,000, here is my take. Scrap Brisbane, scrap Perth, scrap Adelaide. Focus on Melbourne and Darwin. The other cities have already had their run. They doubled in 5 years. That growth is not sustainable, whereas Melbourne and Darwin are just beginning their next growth cycles. So from here, your choice depends on your risk appetite. Do you need a higher rental yield? A lower maintenance property? If so, the house in Darwin fits your brief better. If you want an older house on a developable block of land, you're going to get that in Melbourne. And in terms of growth, Darwin is going to give you that quick uplift in order to refinance in 18 months' time to buy your second property. Melbourne's not going to do that. Or at least it's very unlikely that we would see that level of growth in Melbourne over the next 2 years. Melbourne is the asset you buy and you hold it until retirement. You put a granny flat on it, improve the yield that way, but it's not a flip. Either way, your budget of $700,000 is going to go a lot further in both Melbourne and Darwin, as opposed to the other cities we mentioned. Now, if you're working with that entry-level budget for your very first investment property and you still feel uncertain about where is best for you, you can reach out to me or a member of my team and we will run you through the step-by-step buying process of investing interstate. We can discuss your needs and help you decide on the best location for you. There will be a link attached to reach out to myself or a member of my team to discuss your next property investment. And if you're watching this on YouTube, make sure you like and subscribe.